All right, so good morning. Welcome to the Stockscores Foundation overview. Today what we're going to do is take the material that is found in the foundation area of the Stockscores Education Center and summarize it. Go through it maybe in a broader, more simple way, tying it all together, taking out the really important points from that material. And I don't want to discourage anyone from viewing those videos. They're important to view them, but this will give you kind of the highlights. And so if you need more detail about a particular topic, then you can go into the individual modules that are found in the Stockscores Foundation in the Stockscores Education Center. And of course, in there also you will find assignments and tests and videos and that sort of thing. So certainly if this is your first touch on the Stockscores approach, that's great, but make sure you go back to that material as well. So as I said, today we're going to focus on the most important concepts, really provide an overview of how all of these concepts in the foundation material work together. My aim is to set you up for the application series that we will do later this month. For the investor, that's really next week, starting on Monday. Now we're skipping Tuesday because I have something I have to do, and then Wednesday, Thursday, and then the following Monday. So there will be 4 investor application sessions in the evening from 6 till 7 Pacific time. We'll do market scans. We'll try to pick some stocks together. For the active trader group, we'll be going all month. You will watch me day trade. You will hear my live trade alerts. But for the first week, I will also educate you on how to build your watch list and rate the stocks in that watch list so that you can focus in on the best candidates. We'll talk a little bit more about that later today. As I said, that starts Monday. It goes all month. Monday to Friday, but the education sessions, which are the only ones that will be recorded, will be for about the first hour of Monday, Tuesday, Wednesday, Thursday next week. All right, so ultimately what we're trying to do, whether we are day trading or swing trading, is find stocks that make us money. And it's really about stocks breaking from predictive chart patterns. So this is a stock that gave a break from a predictive chart pattern there and there. And my goal by the end of the day is to make you understand why and be able to see that as quickly as I do or as people that have taken my course in past years do. It takes some time and some practice, but it's really important that you keep it simple to know things that we're going to talk about today, which are 6 essential elements of chart patterns. And that's really all you need to know. I have tried everything. I've been doing this for 27 years trading. And I've tried all the indicators and I've tried very sophisticated analysis, and I always come back to the 6 things that I'm going to teach you today. So it doesn't have to be more complex than that. Now that is a daily chart. It represents what has happened, in this case, over the last 2 trading days, or the current 2 trading days. So this would be the last trading day, and this would be the previous day. There's a big line down the middle there. You can see the dates. These are old charts, but they serve the purpose. On the bottom here, you have volume, and so you can see an increase in volume and then even more of an increase in volume. Along the vertical axis, you have price, and you have time going this way. In this case, this particular chart is a 2-minute, 2-day chart, and you can tell that by looking up in the top left. It says 2-day, 2-minute chart. Each one of these bars, which we call candles, represents a 2-minute period of trading. So in this case, the market opens at 9:30 Eastern Time, and at 9:30 it opened there, and it went up, and it topped out there, and then it kind of drifted lower through the day to close the day down there at 4 p.m. Eastern Time. Now we can look at charts in longer time frames as well. This is a 15-day, 13-minute chart of the same stock. And in this case, each bar represents 13 minutes. And I'm always asked, why do you use 13-minute charts? And the reason is that there are 30 13-minute charts in a day. You can't do that with a 12-minute chart. They don't, there's not an equal number of minutes in each candle when you do a 12-minute chart or a 14-minute chart, but 15-minute, 13-minute, they all have equal numbers of candle or minutes in a candle. And I just like the 13-minute chart. I find it works well. for swing trading. So what we look for as swing traders is things like this. When stocks come alive after being boring, you'll learn a lot about that this morning. And look what happened to that stock. It went up very quickly. So our aim today is to be able to take all the pieces that made that a good stock to consider, put all those pieces together so that you can see that. It takes a little bit of practice, but it's not too hard. You can look at charts on an even longer term time frame. This is a 3-year weekly chart. And in this case, each bar represents a week. So we have here going back 3 years, and the stock was in a downward trend, and then it broke its downward trend from a rising bottom. That was our cue to take a look at it in more detail. And if you follow tech, you know that it has gone even much higher than where it is in this chart. Now in this one, we also have the Stockscores indicators. So what we like to see with the Stockscores indicators is the green line to be above 60. So it crossed above 60 somewhere in there. And the blue line to spike up above 80, which it did there. Those indicators were designed by me to look for the elements of good chart patterns. And what we'll talk about early in this session today is what are the elements of good chart patterns. And there's only 6 of them. If you understand those 6, then you have everything you need to know to read a chart. But you have to understand them really well. So we're going to go through those fairly slowly. Now before we get into that, I just want to give you a little bit of basic theory about price. People always ask me, do I need to know anything about the stock market to take your course? And the answer is no. I'm going to start you at the most basic of concepts. And in fact, knowing too much about the market, if you've traded for a long time, sometimes that can be detrimental because you have some bad habits or some beliefs that maybe aren't warranted. Not to say that you have some great beliefs. You could be trading for 20 years and have some great habits, and you just need a few little things to make you even better. But either way, I don't want anyone to think that they have to know a lot about this coming in, because if you can draw a straight line with a ruler and understand some basic theory, then you can understand my approach to the market. So what is the reason for stock price changing? Well, first of all, we have to understand what price represents. Price represents the value of the company, and the value of the company is based on its ability to make money in the future. So if we're here in today, okay, so this is today, and we want to know what is a company going to make next year, and in 2 years, and in 3 years, and in 4 years, and off into the future forever. And what's important to understand is that money made in 1 year, okay, this amount, let's say the company makes $1 million next year, that is worth more than $1 million in 4 years because of the time value of money. If you had that $1 million next year and invested it, it would grow in that number of years to maybe 100 or 1,100,000. I don't know, I'm just throwing out numbers. So that's why money today or money soon is worth more than money later. Okay, and that's called the future value or the present value of future earnings expectations. That's what they teach you in year 1 business school. Let's keep it simple. All we want to know is, our company's going to make money in the future. You could have a mining company that's out exploring for a gold mine. They may only spend money today. They may have no revenue. Snapchat only loses money today, and yet it has a multi-billion-dollar valuation. And the reason is the market isn't worried about what it makes today. It's worried about what it makes in the future. Okay, when Facebook first started, it didn't make any money. But over time, it started to build its revenues, make itself profitable, and today it's a very profitable company. So keep that in mind when you're looking at companies. It's all about what is the value of future earnings. Now, the stock market is a place where investors argue about that. So every day in the stock market, you have buyers and sellers arguing about what the company is worth. Now, if let's draw me here, super happy. If I think a stock is worth $100 a share, and you, equally happy, think a stock is worth $110 a share, then if it is at 105, if it is trading at $105, I am likely to be a seller because I think the stock is worth less than what it's trading at, and you are likely to be a buyer because you think the stock is worth more than what it's trading at. Now let's remember that one of us is wrong, and we'll only know in the future based on where the stock price goes. If it goes up to $115, then you were right. You weren't right on the valuation, but you were right on it being undervalued. If it goes down to $90, then it's me that was right. And so every time there is a trade in the stock market, it's really a transaction between a buyer and a seller. And the buyer has one opinion, the seller has another opinion. Now there's a lot of uncertainty, there's a lot of uncertainty in that decision because we don't know what the company will make in the future. We have to guess. Now we can make intelligent guesses by doing good analysis. And what fundamental analysts do is they try and figure out what a company is going to make in the future. But there's a lot of uncertainty in that. We don't know with certainty what Microsoft will make next year. We don't know with certainty what a biotech company will make next year. Now there is more certainty in Microsoft, MSFT, more certainty because it has a history of earnings that we can judge, and they have a known suite of products that we can evaluate. But that little biotech company that's never sold a drug, who's just developing drugs, it's highly uncertain. And so this stock will be much more volatile in price than Microsoft because this little junior biotech company that's trying to develop a new drug to cure cancer has a much more uncertain future than Microsoft does, because Microsoft is well established and has been around for a long time. Now the last thing I want to talk about in this point is mood. Because if we believe that companies will move up based on the value of future earnings, and we recognize that there is uncertainty in what that value is, we have to also recognize that the mood of the market has a huge effect on how we evaluate the earnings potential. If the market is in an upward trend and investors are feeling optimistic, then they are more likely to put a higher valuation on the value of future earnings because they are optimistic. When stocks are in a downward trend, we have fear, we have pessimism, and that causes us to want to pay a lower price for a company. So in trading, there's something called the law of upticks. When stocks are moving up, we tend to be more optimistic, and we tend to put a higher valuation because of our mood. And so it's very important to not just be a robot and look at valuation based on this value of future earnings, because in the short term, you can get stocks that go far beyond their value because of optimism or pessimism. If I was to draw a line based on how future earnings are going to grow for a company, it might look like this. But along the way, the stock price could go like this. And the reason is there's optimism, and there's pessimism, and there's optimism, and there's pessimism. And that's what causes price to deviate from its true fundamental value over time. So mood coupled with uncertainty is why we have volatility in the stock market. This is the volatility. If you have a stock doing this, it's not very volatile. This is volatility, and this is how we traders make money. So what traders want is a volatile market. We don't always get it. For the past couple of months, the market has been at historically low volatility. Investors don't have a lot of uncertainty about the market. They feel confident in the prices that it has given to stocks because, or we know that because of the lack of volatility. But when uncertainty comes, like when Trump was elected, so if you remember back in November, the market was moving lower, and then everyone thought Clinton was going to win, and the market started to move up. And then Trump won, and in the nighttime session, it went way down like this, But by the morning, it had come back up. And then in the weeks following the election win in November, the stock made a very sharp run higher because there was a catalyst for volatility. There was a catalyst for significant price change. And that was caused by the expectation that Trump's policies, which are lower taxes, less regulation, would be a positive for stocks. And that's why we had that huge rally after November. Now, since then, we've gone into low volatility again, and there will be another catalyst. We don't know what will be, but there will come a catalyst, and that will give us volatility. And maybe it'll go to the downside. Maybe it'll go to the upside. Ultimately, we do what the market tells us to do. Now, in order to get there, we have to understand some basic ways of analyzing stocks. And to really beat the market, if we want to outperform the market, we have to look for those stocks that move faster than the market. We call these alpha stocks. Alpha stocks are those that have significant fundamental change underway, or at least the perception of significant fundamental change. A company like Netflix, if you think this is the S&P 500, Netflix has done this, or Amazon has done this. Well, those companies have grown their earnings or their market share much faster than the overall market. They are alpha stocks. Now, we can have alpha stocks on this is, say, 5 years ago. This is today. We can have alpha stocks over a very long time period. Could arguably go back even farther than 5 years. So Amazon and Netflix and Tesla, these have been alpha stocks for a number of years. But we can also have alpha stocks just today. In a single trading day, we will always have some stocks, if the market's doing this, that do this, because they have some news out, or they've announced earnings, or there is a rumor of them being bought by someone else, or there is a rumor that they found a major gold discovery. And so those things are significant fundamental changes in the business. And whether they are true or not, what all that matters is the perception among investors of what that is. And once you get it started in the day, once you get a little bit of movement up, the crowd will tend to pile on to that stock, and you'll see a significant jump in volume. And that crowd mentality of chasing after these stocks is what we traders love, because it sends stocks even higher. So how do you find these winning stocks? Very simple. We focus on stocks that are going up through resistance and those that are behaving abnormally. My job this morning is to give you the basis from an analytical standpoint to understand how to do that. Because just doing this, which is some pretty simple things, look for stocks going up through resistance, look for those behaving abnormally. It's very simple, and that's all that I really do, but to do it well, you have to really understand how to define what resistance is, and how to understand what is abnormality, and what are the best situations to focus on this and ignore those that don't end up doing all that well. Here's a very important statement. Almost all stocks that beat the market start their market-beating trends with abnormal activity. However, not all abnormal activity leads to market-beating trends. So in other words, if you look at the 100 top-performing stocks of the last month, I would guess that 90 of them, roughly, started their market-beating return with what I call abnormal activity. I'll teach you what abnormal activity is in a moment. But there were probably 1,000 stocks in the last month that did something abnormal. And so we need a way to go from this 1,000 down to the ideal 100 so we can hopefully find the 90. How do we qualify the trades that are worth taking? We use chart patterns. Chart patterns help us qualify what abnormal trading activity is important. And to understand chart patterns, we have to first understand this concept of inflection points. They are the building blocks of chart patterns. If you can understand inflection points, you have everything you need to know to be able to identify the 6 elements of chart patterns that I will discuss. So what are they? Inflection points are the price point where price changes direction. So if you have a stock going up, and then it goes down, and then it goes up, and then it goes down, these peaks and valleys are the inflection points. These are inflection point highs. These are inflection point lows. They're the building blocks of chart patterns because eventually we're going to draw lines across those inflection points to define price patterns. Now the way that I find inflection points is I have a simple rule. If there are 4 candles to the left, sorry, this should be left, and 3 candles to the right, then I have an inflection point. So what do I mean by that? Here we have this candle has 4 candles to the left, 1, 2, 3, 4, that are below the high of that candle. And it has 3 candles to the right that are below the high of that candle. So we can call this an inflection point high. So just keep that really simple rule in mind. 4 candles to the left, 3 candles to the right. For inflection point lows, we can do the same thing. If there is a candle that has 4 to the left that are higher than the low point and 3 candles to the right that are higher, then you have an inflection point low. If we had 1 candle that was lower than this candle, then it would not be an inflection point here. So let's look at some examples and try to identify this. Look for candles, look for price peaks or price bottoms that have 4 candles to the left or 3 candles to the right that are either higher than the high or lower than the low. Sorry, lower than the high or higher than the low. So let's do one together. Let's pick this candle right here. That high point is higher than at least 4 candles to the left and at least 3 candles to the right. In fact, it's higher than all of these candles going all the way back to here. So if we were to count, we would probably count 40 candles to the left. And if we were to count how many to the right, well, we'd probably count 70 candles to the right. So because there's 40 candles to the left and 70 candles to the right that are all lower than this one, this is a major inflection point because it's got a lot of candles on either side of it that are below the high. This one, this low point, is lower than all of these candles and lower on the left than all of those, and we could even go back farther. So this is a major inflection point low. But there's also minor ones on this chart. If I pick this candle right here, I can see that there are candles maybe going back to there, so probably 20 candles to the left. Now on the right side, gosh, there's a lot again. That's actually a pretty important one. How about this one? Well, there's 1, 2, 3, 4, 5 candles ago is the first one. So there's 4 candles to the left and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 to the right. So there's 4 to the left and 13 to the right. So that qualifies as an inflection point, but it's not as major as this one was. So visually, if I want to just quickly define these, it's not very hard. Just look for peaks and valleys. I would say, well, there's an inflection point. There's one. Maybe there's one. There's one. There's one. If I want to do some lows, I'd go here and here and here and here, here and here, and there, 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 there. Okay, this one's close, isn't it? Because I have to count to the right. 1, 2, 3, and it's the 4th one to the right that is taller. So it just qualifies as an inflection point. Now I created an indicator for TradeStation, so for those of you that are in my Active Trader course, you will get this indicator emailed to you. Well, actually, it's actually inside TradeStation. So there is an indicator on this chart called a pivot high and a pivot low. So for those of you that use TradeStation, they've actually developed an indicator to do this. See these little X's on the chart? It's a little bit hard to see. I'm going to try to circle them for you here. There's one there, there's one there, there. So those little plus signs, there's green ones on the bottoms, those are inflection points. Okay, in TradeStation they call them pivot low and pivot high. And it's an indicator that you can plot on your chart. And you can tell it how many candles to the left and how many candles to the right do you want it to be. Now I use 4, so 4 to the left and 3 to the right. But you can define that. You can make this 10 to the left and 10 to the right, and then it's going to have fewer of these inflection points on the chart because it's harder to qualify, right? These ones wouldn't qualify. It would be this one, maybe this one, this one. So you get fewer of them. Now for our purposes, and what I'm going to teach you in the strategies and that sort of thing, I find 4 to the left and 3 to the right works best. Okay, let's do some inflection points on a different chart time frame. This is a 2-day, 2-minute chart. Just look for peaks and valleys. Don't worry about counting so much. I mean, if you want to get really technical, you can count, but it should be pretty obvious. If you see little peaks and valleys, just put a little mark on them, because we're just going to draw dots, and then we're going to connect the dots to define patterns. Okay, and we could go back into the previous day and put some more on there. And ultimately what we do is we draw lines across these patterns to define trend lines and channels and flags and all the things I'm going to teach you this morning. Okay, before I move on, I just want to make sure there's no questions on inflection points. If you have any, let me know. See, there's a couple questions here. What is the time period for a candle? Well, a candle can have any time period. So at the top, I was showing you a 2-minute chart. It was a 2-minute candle. 13-minute chart, 13-minute candle. Daily chart, daily candle. You can apply this method whether you're looking at a weekly chart or a 2-minute chart. You can actually have a 10-second chart with some programs. When you're looking for inflection points, do you consider the tails or just the bodies of the candles? For inflection points, I use the tails, but you can define it using the highs and lows as well, or the closes and the opens. So let's go back to a chart. And in fact, I'm going to go into TradeStation here. And so what the question is should we put the candle in, or should we put the inflection point up at the top, like right there at the end of the tail, or should we go across the body, which is right there? I find that the tails work better for inflection points, but you can do either. And actually within TradeStation, I right mouse click here and go Format Analysis Techniques. And this is jumping ahead. It's not something everyone's going to do because you're not going to use TradeStation, but I just want to show you what you can do. It actually allows you to tell it whether you want to do based on the high or the open or the close or whatever. You can tell it whether you want to use the bodies or the highs. So I use the highs and lows, but you know, you can try different things, experiment with it. I've done that work and I found that using the tails of the candles works better. All right, let's make sure that there's no other questions and then we'll move on. Looks like we're good. All right, so let's get into the 6 elements of chart patterns. So give them a look, read through them. We're going to go through them one at a time. So every trade I do, and every trade I've done in the last 25, well, maybe not 25 years because I didn't always do this method, but let's say the last 20 years has been based on these things right here. Support, resistance, optimism, pessimism, price volatility, and abnormal activity. If you want to learn how to read charts, if you want to get the message of the market to make your trading decisions, then that's all you need to know. Because every bit of fundamental information about a business, everything that people know about the company's ability to make money in the future, is voted on by investors by buying and selling. So that's the vote. And that is what creates the chart. And I have to teach you how to read the chart. It speaks its own language. Okay? If you can read the chart, then you'll know what people are voting, and you will ultimately know if the fundamentals are getting better or worse. So people often say, well, you're a technical analyst. I hate to be called a technical analyst because I think making decisions based on lines is silly. What I am is a person who understands that the fundamentals come into the chart because of people voting with their money. That creates the chart, and I just have learned how to read the chart, and you will learn as well. So let's begin with the first element, which is support. Support is a floor price on a chart. It's the lower boundary of what investors think the fundamentals are worth. And to find it, we just find the inflection point lows and draw a line across them. We can have a horizontal line, or we can have a line that is sloping up or down, which is an indication of trend. So if I was to just draw a little mock chart here, okay, these are my lower inflection points, right? And I could say, well, this is the lowest that anyone has been willing to sell that stock for in the time period of my chart. And there was other support zones here because that's where, for that shorter time frame, that was the lowest price that people were willing to accept for that stock. So that is support. I can also draw a trend line across those to define a trend line of support. So we have two types of support. We have horizontal and we have trend lines of support. Now it's not an exact science. You know, if I drew my chart like this, I could say, well, there's support, there's support, there's support. And to draw a trend line, I could draw the best fit line. Yeah, it doesn't touch everyone exactly, but sometimes you have to generalize the trend. Okay, so let's look at some examples. Start by finding your inflection point lows and draw lines across them. So we have an upward trend line that was like this. We also had horizontal areas of support in these areas over here. All I'm doing is I start with the building blocks of chart patterns, the inflection points, define them, and draw lines across them. Draw horizontal lines and see if you can also draw a trend line. So that is a trend line of support. Now what does it represent? Well, in this chart, the lowest price that anyone was willing to accept for this company was about $8 a share. What that meant is that the people voting in the market every day, the buyers and sellers, did not think that this company was worth less than $8 a share. So they looked at all of the fundamentals of the business. This is a drug company. And they said, based on everything we know about this company in this time frame, which was about a year, we don't think the stock is worth less than $8 a share. But in shorter term time frames, there's actually a different boundary. In this time frame, which was just 2 months, investors didn't believe the stock was worth less than $12 a share. If it had gone below $12 a share, it would have implied that some investors found some fundamental reason to accept a lower price. And so the market told us what the fundamentals were. Because in the market, it's not one person voting, it's thousands and thousands and thousands of people. And one person is not smarter than the crowd. Because even if the crowd is wrong, they're still right because they drive the price action. So I gave up trying to be a smart guy a long time ago. I try not to think when I'm trading. My book is called The Mindless Investor because I would rather trust the crowd than trust myself, as long as I am willing to change my view when the crowd shows me signs that it is doing the same thing. I always want to be one step ahead of the crowd by following the smartest people in the crowd that start the trend. That's these guys up here. So moving along to resistance. Resistance is a ceiling price. It's the upper boundary on what investors think the company is worth. So if this is $10 a share, what investors said is over this time period, we do not think this company is worth more than $10 a share. Every time price got up to it, it got stuck. Got up to it, it got stuck. Here again, it got stuck. So the market's telling you that it doesn't think the fundamentals are worth more than $10 a share until one day when some investors in the crowd of investors said, hey, we think the fundamentals of this business warrant paying $11 a share. We have a good reason to pay $11 a share. We've done some research, we've learned some new information. And so those people, when they pay $11 a share, they're telling us that all of the people who have been unwilling to pay more than $10 a share were wrong. And the only reason these people do it is because they have new information. Now, inflection points that are touched multiple times, like this one was, are more important. That's a strong level of resistance. If you have an inflection point that's only touched once, it's not as important. And it's also how long has the inflection point held up. If we had a high point up here that has held up for 100 candles to the left and 100 candles to the right, that is a major inflection point. And so what will happen is when the stock gets up to that level again, it will likely get stuck because over the course of a long period of time, no one has been willing to pay more than, let's call it $12 a share. Always easier to look at it with a real example, so let's look at Horizon again. And let's start by finding our inflection point tops. Maybe one over there, one here. And let's try to find the line that best fits as many inflection points as possible. That would be this. Okay, yes, there was a brief little spike above it, but it was only one day. So that is the upper boundary of what all of the people that traded this stock over that period of time, all of these people, you think about it, this stock was trading anywhere from, probably 1 million to 6 million shares a day. So millions of shares traded, and no one was willing to pay more than $14 a share until here, when the market finally broke through that resistance level. And look what happened. Now, why does that happen? Well, the people that bought on this day are usually the people that know the most. They're the people who follow the company the closest, and they had some information that justified paying a higher price. Based on all of the information that that group of people that were buying that day had, they felt that there was a reason to pay a higher price. Now, and that was probably a small group of people. Now, as more and more people learned about that information, more and more people were willing to pay a higher price. Now the crowd is growing. Okay? Lots more people are paying higher prices because they learned of the information that these people knew back here. Now, I want you and me to be part of this group. But you and me do not get good information. We're not big hedge funds with, multi-million-dollar budgets for doing research. We don't have PhDs on our staff to do the analysis that is necessary to understand what this drug company is doing. It doesn't matter because we'll just follow what these people do. When a stock breaks through resistance with abnormal activity, which is what happened right here, Volume was higher, price action was higher, breaking through resistance. What the market is telling us on that day is, hey, there's something here that is important. We don't want to be the group buying up here who are late to know. We want to be with the group down here that are early to know. And you don't need to know anything. You just follow the people that do. Okay, I'll pause for some questions before I move on to optimism and pessimism. Do you use 13-minute intervals in your demonstrations? Is there a specific reason? Yeah, if you watch the video, I explain the reason. But the basic reason is that there are 30 13-minute intervals in a day, and I find they work well. But I did answer that or discuss that earlier in the presentation. So if you came in late, just watch the video later and I go into more detail on that. Okay, I think we're caught up on the questions, so let's move on to optimism and pessimism. Now remember I spoke earlier about the mood of the market being important? Because how investors judge information is largely dependent upon their mood. And so if we have investors optimistic, they will give a higher valuation to the fundamentals than if they are pessimistic. And so we need to understand how to read optimism, because stocks that have optimism are more likely to move higher than stocks that have pessimism. Very simple. If the inflection points are rising from left to right, then we have optimism. If they are rising very steeply, then we have very high levels of optimism bordering on euphoria. If it's kind of a flat upward trend, then we have less optimism. So the steeper the rise, the more optimistic investors are. So looking at this chart, I can just highlight my inflection points. And I can see that here we have optimism, and then the trend gets steeper and steeper. This up here means investors are getting emotional. Okay, they're getting a little crazy, chasing the stock higher. Here they're just generally optimistic, but anytime you get the trend steeper into a parabolic trend, which is this curve here, what you really have is investors getting somewhat irrational, chasing the stock higher. Pessimism, exact opposite, means the sellers are in control. If the inflection points are falling from left to right, then you have pessimism. The steeper the fall, the more pessimistic investors are. So here we had optimism, and then look what happens. We switched from rising bottoms to falling tops. So we went from optimism to pessimism. We want to be a buyer or an owner when there's optimism. We want to be a seller when there's pessimism. And so when you switch from rising bottoms to falling tops, breaking down through support, you want to be a seller. And vice versa, if this stock had been moving lower, when you switch from falling tops to rising bottoms, you want to be a buyer. Now we can take those inflection points and use them to draw trend lines. We talked about support and resistance and how we can draw horizontal lines of support and resistance, but we can also draw trend lines. Trend lines are a type of support and resistance, but we separate them out because they help us with some of the strategies that we do. They're drawn across inflection points that rise or fall over time from left to right. They're made up of directional moves followed by counter moves. So if we have an upward move in price and then we have a pullback, and then we have an upward move in price and a pullback, now we can define a trend line. This is not the trend. This is a move. Trend lines are formed by the inflection points that define them. By the same token, downward trends will often look like this. So we have inflection point highs, we have a move down and a pull up, move down, pull up, move down, pull up. and it's those pull-ups that define the trend line. So here, I can define the trend line by the pull-ups. And I can define the downward trend line, which gets steeper, by the pull-ups. Sorry, these are the pullbacks. Okay, when I'm day trading, I have a strategy where I look to buy here and here on the breaks of the pullback. You can short stocks when they break the pull-up. But we'll get into those things with the strategies. Okay, so that's optimism, pessimism. Price volatility is next. The breadth of price change over time is price volatility, and it's all relative to the stock's history. So if a stock is really volatile, and then it gets kind of narrow, and then it gets really volatile again, this is low volatility, and this is high volatility. And it's all about how price changes over time relative to what it normally does. Now what we really want to see, this becomes very important when we're defining good pattern breaks, is convergence or divergence of volatility. So let's say I had a pattern that looked like this. Okay, so this is time, this is price, this is the chart that I've drawn here. Let's draw my inflection points. All right, if I draw a line across these inflection points, and those lines are converging toward one another, we have a period when volatility is lowering. There is a convergence of my lines across the tops and bottoms, which help us to see the price pattern. So when the lines that you draw across the tops and bottoms are converging toward one another, you have diminishing price volatility. If the lines that you draw across the tops and bottoms are expanding or diverging, then you have greater uncertainty. This is confidence. This is uncertainty. It's always easier when we look at a chart. So if I draw some inflection points on here, and I draw a line across those, and I draw a line across that, what I see is that there's very low volatility here compared to here. So this is low volatility, this is high. If I was to draw a line across these inflection point bottoms and tops, I would have the lines moving away from each other. Here they're moving toward one another. And then here they start moving away from one another again. And then we have a period here where they start moving toward one another. Here we have lines coming toward one another. So low volatility there, low volatility there, high volatility here, high volatility there, high volatility here. It's important to understand that because what this really means is that investors all agree about what the stock is worth when there is low volatility. That's something I talked about right at the start today. When you have low price volatility, you have the buyers and the sellers agreeing. Okay, they're happy. They agree about what the company is worth. Let's make these guys shaking hands here. Hey, we agree. We agree that this stock is worth $13 a share. When it breaks out of that, that means one group has found a reason to pay more, and so they no longer agree anymore. There's much more volatility, therefore more uncertainty about what the company is worth. Maybe I shouldn't draw stickman drawings. Now our final element is abnormal activity. Abnormal activity occurs when price changes more than you would expect and the volume traded is higher than you would expect. So let's say Microsoft is kind of going like this. And it trades maybe up or down 0.5% in a day. Doesn't make big moves. It maybe trades volume-wise, maybe trades, I don't know, 20 million shares a day. It probably trades more than that. And then one day, it jumps up 3% and it trades 50 million shares a day. That is abnormal volume and abnormal price movement. And we can measure that mathematically or statistically. And I've developed some indicators to develop that or to measure that. And these indicators are the key, or this concept is the key component of many of my strategies. Now think about what's happening here. Everybody agrees that Microsoft is worth $40 a share. And one day it jumps to $41.50 a share. Why would this group of people pay more for that stock? Probably because they have some new information that justifies them paying a higher price. And because that jump stands out statistically with much more volume statistically and much bigger price jump statistically than normal, what it really means is that it doesn't happen very often. It's not a fluke. Now remember I said earlier that almost all market-beating trends start with abnormal price and volume action. At least abnormal price, not always abnormal volume, but almost always there is abnormal price action. It stands to reason because price moves up abnormally when investors are aggressively buying the stock. And investors aggressively buy the stock when they have some new information to justify paying a higher price. So looking at this chart, we have consensus among the buyers and sellers that this stock is worth $13 a share. And then we have some people who start saying, actually, I think it's worth $14 a share. And then we have a real strong day here when it jumps to $15.50 a share. And look at how the volume increased. We had a little bit of an increase there and then a bigger increase there. That volume was higher than any day going back 2 months. For 2 months, it didn't trade as many shares, and for 2 months, it certainly didn't have a price jump like that. In fact, this price jump on that day was the biggest price jump that I can see on this chart going all the way back, right? I don't see a bigger price jump than that. Now, there was a bigger price jump here, so that day was also abnormal. And if you look at the volume, it was also abnormal. And then look at this big jump in volume and this big price jump there. But we want to catch those that come out of low volatility. Because when you have low volatility, you have everybody agreeing. And then you have some investors who disagree. And it's those investors who are telling us, the masses, that they have some new information that justifies paying a higher price. And we don't have to know why they did it. We don't have to care why they did it. We just have to know that people don't put their money in the market with the expectation to lose. The reason people buy and the reason people are willing to pay more is because they want to make money. And if you can catch those abnormal breaks from low volatility through resistance from optimism, you have the recipe for a stock that has a high probability of going into a market-beating trend. This stock, nobody cared about it, no volume, and then on the open, look at the volume jump up. Look at the price action jump up. So the people that started buying that day were probably getting some information that justified paying a higher price. This is a small group of people. And then there's more people. And then there's even more people. And here you have the big crowd, everybody buying. Okay, you want to buy with the small group of people, and you want to sell to the crowd. You want to be one step ahead of the crowd. So using these concepts, we can define predictive chart patterns. Before I move into the predictive chart patterns, maybe I'll just make sure there's no questions that I need to answer. So in other words, low volatility is where support and resistance meet. Well, if you define support and resistance by trend lines, yes. So as long as your your line across the tops is converging with your line across the bottoms, then yes. So I'm trying to get my screen back here. So, because you can also have horizontal lines of resistance that maybe just go like that. We want those trend lines of resistance that converge. And they don't always have to look like that pattern. They can look like this. They can look like, this is a pattern called a rising wedge. So all of these patterns here, with the exception of this one, are patterns of converging volatility. Flags are a unique one, which are, well, I'll explain in a moment. Trend reversal is a little bit different too. Okay, any other questions before I move on? I'm gonna have a drink here. All right, well, let's start learning patterns then. So all of these things, these concepts that we've done so far, which are optimism, pessimism, support, resistance, price volatility, and abnormal activity, we use them all to define patterns. So what is a triangle pattern? We have ascending triangles. Can't remember if I explained this. Okay, an ascending triangle has rising bottoms into a flat top. We have descending triangles. These are all discussed in the video on predictive chart patterns that's in the foundation area. We have pennants, which look like that, falling tops and rising bottoms. We have rectangles, which isn't really converging volatility, it's just low volatility in a sideways trading range. We have cup and handles, which is a pattern that looks like this. So we have a lot of volatility in the middle in the cup, and then in the handle we have low volatility. So my line that gets drawn across the tops and bottoms are still converging. It's kind of a unique pattern because there's a lot of volatility in the middle and low volatility on the sides. Head and shoulders, which is kind of a famous chart pattern, looks something like this, where you have more than a low volatility break, you have movements from falling tops to rising bottoms, and then you get a convergence of volatility on the right-hand side. So what's important about this is you're changing from pessimism to optimism. And when you get your break over here, which is through resistance from the low volatility in the right shoulder, then you've got a opportunity to see that stock go higher. I'm not going to spend a ton of time on these individual patterns because they are explained in a foundation lesson. What's important though is to understand what's behind them. So let's look at some examples and just see these patterns. Okay, so this is an ascending triangle. I drew a line across these inflection point tops, and I drew a line across these inflection point bottoms, and you can see that volatility is converging, diminishing over time, and the bottoms are rising, so you have optimism, and you're breaking through resistance right there. So that's an ascending triangle. This is that unique pattern I talked about, which isn't really a convergence of volatility, it's more of a pullback. So we have an upward move, and then we have a pullback, and we have a break of a pullback right there. This is a great buying opportunity. It's a break of the pullback. This is called a flag pattern. This little thing here, it looks like a flag. And when you get breaks of flags in upward trends, you often see price continue higher. I use that a lot when I'm day trading. Okay, here's some more ascending triangles, rising bottoms towards a flat top. Volatility very low here and very low here. What we want to look for are the breaks from low volatility. What I just said, we want to look for the breaks from low volatility. That is the thing I find most of my students forget. They get resistance really well. They get optimism, that's easy. But this concept of breaking from low volatility is something that people miss a lot. So I'm going to emphasize it here because you really want to see that low volatility before the break. This is not a break from low volatility because the stock's been moving up for a while already. This is a break from low volatility. This is a break from low volatility. But buying up here, you're too late. You're not buying the break from low volatility. Here's a rectangle consolidation. There's the break from that sideways trading. Investors agree that this stock is worth between $7.80 and $8.20, and then one day some people are willing to pay $8.50. That tells us something. Here's some flag patterns. As I said, I do these in day trading a lot. Here's a move up, a pullback, buy the break of the flag, because you often get a move out of it. Here's another flag, break of the flag. Here is a pennant, falling tops, rising bottoms, but the trend into the pennant was up, which makes this an optimistic pennant. If the trend into the pennant is down, then that's a pessimistic pennant. What you want to see, though, is the break from the low volatility, which happened right there. That is your pattern break, your buy signal. All right, let's go over another concept called price channels. It's kind of a pattern, but we can trade channels as well. So a channel occurs when you take a line across the bottoms and a line across the tops, and it forms a channel. They are two parallel lines moving, in this case, up, but you can have downward sloping channels as well. And what you want to be aware of is you don't want to be a buyer up here. You want to buy at the bottom of the channel. So once the channel is defined, look for opportunities to buy as it's bouncing off of the bottom of the channel. And don't chase the stock into the top of the channel because it's probably going to get stuck. See channels all the time. So here's the S&P 500. I've got the bottom boundary, and I've got a parallel line that cuts across the tops, and I don't want to be a buyer up here. I want to be a buyer at the bottom of the channel. At least that's one strategy. Or perhaps in the middle, because this channel got kind of narrow there for a while. So when I do my weekly market minutes video, I'll often define the channel. And if you watch this week's market minutes video, which is on YouTube and it's on the Stockscores homepage, free to watch, in this week's video I talk about the price channel for the S&P 500. Because the S&P 500 had a pretty good finish to the week. Thursday and Friday made good gains. And so it's taken the S&P 500 in the very short-term chart, the 13-minute chart, it's taken it up closer to the top of the channel. Not at the top yet, but close. And so my comment was, it's probably got another couple up days before it gets stuck and makes it back to the bottom of the channel. So what has changed in the market over the years? I've been trading a long time, and I still use the 6 elements. I started using those, I'm going to say 20 years ago at least, maybe more. I still use abnormal activity as my #1 thing that I look for. But there are some things that have changed. The market is more efficient. And so where I used to maybe wait for these breakouts through horizontal resistance, now I try to catch them a little earlier when they break trend lines of resistance. Because the market is more efficient, there's more people trading it, there's computers trading the market, and so it's important to get in earlier than the crowd. Looking for abnormal activity that breaks trend lines of resistance is now more important than horizontal resistance. So I know some of you are repeating this course. Maybe you took my course 10 years ago. That would be the biggest difference that I do today, is that I don't wait for the breaks of the horizontal resistance. I look more for the breaks of trend lines of resistance. You want to just jump in a little bit more ahead of the crowd because the market has become more efficient. So, you know, on something like this, there was a trend line of resistance here. That was a good buy. There was a trend line of resistance here. That was a good buy. In the old days, I might have waited until here, In this case, it didn't matter. But now I jump a little earlier. I want to see, where's that trend line? Okay, there was a break of the trend line. I'll buy that. In the old days, I might have waited for this to be broken. Okay, but it reduces profitability. And you have to be a little sharper, a little quicker, because the margin of error is tighter than it used to be. That's just simply because the markets have become more efficient. So looking at a 13-minute chart, here the stock, nobody cares about it, and there's the break. Get in early. Catch that first break through resistance from optimism with abnormal activity. Enjoy selling to the crowd up here, or maybe over here. On a very long-term chart, I've showed you some short-term charts, but the concepts are exactly the same. Here you have pessimism, and then you start switching to optimism. And so if I draw my trend line, I can see the trend line broken there. I can see the first break from optimism here. I don't want to be the public buying over here. I want to buy with the smart money, the people that know the most about this company, and buy it early. Look at the stock scores. As the stock is suffering, the stock scores are low, and then they start to move up and the stock scores get better. Because what they evaluate are the 6 elements of chart patterns. They put a score on things like breaks through resistance, rising bottoms, volume and abnormal activity, and price action. So all of those things are factored into the score. About a dozen different components. Every stock starts with 50 points, and I add points for good things like breaks through resistance, like abnormal price moves to the upside. Those get positive points. Falling tops, those get negative points. Falling through support, those get negative points. Okay, I'm going to pause again, see if you have any questions. We're going to move on to a totally new concept now. We're sort of past chart patterns. We'll talk about risk management, but if you have a question, type it in now. Is that entry on break of sloping trend lines instead of horizontal trend lines like in the old days the same for a longer term chart as intraday? Yes. Now the concepts, there's not a whole lot different between day trading and investing long term, or what I call position trading. There are a few minor differences, but if you can understand how to read a chart for a position trade for a stock that you're going to put in your retirement portfolio and hold for the next year, those concepts transfer to day trading just as well. The only thing with day trading is you have to think quicker, you have to act quicker, and you emphasize more the abnormal activity on a very short-term basis. But other than that, it's kind of the same. So does the software alert you for those break and trend lines? So when I'm day trading, I have programmed TradeStation, which is the program I use to trade, to alert me when those trend lines are broken. Yes. And it's important to have the computer do that when I'm day trading, because day trading is very time sensitive. If you want to position trade, then you're going to use the Stockscores website, and it's not so specific in terms of saying we have a break of trend line today. You do market scans in the evening looking for stocks that have certain criteria, and then you have to visually inspect those charts to see if there is a break of the trend line. So it's less perfect. My day trading strategies are mostly computerized, and so I get the computer to do all the work using that program called TradeStation. Stockscores doesn't quite do it as perfectly, but it is easier to use than TradeStation, a lot easier to use. So, in Stockscores, you might have to look at 10 charts to find the 1 or 2 that are having a good pattern break, whereas in TradeStation, I can get it to basically give me only the stocks that meet the rules, because it's just a more sophisticated tool, but it's also a lot more complex to use. What is the time lag from Stockscores and the real-time market? The Stockscores charts are 15-minute delayed. The market scan is about 30 minutes delayed. So it's really not appropriate for day trading. but it works for swing trading as long as you can combine it with a real-time data source for your actual entry points. And it's great for position trading because position trading isn't as time sensitive. Is there a time when a break from volatility not vital? Your previous chart on T.ABT when you went through chart patterns. When there's a rectangle pattern. Well, a rectangle pattern is low volatility. It's a unique one, and the reason it's a low volatility pattern, I'll go back to that one, is because it is still, although the lines across the tops and bottoms aren't converging, okay, these lines are not coming toward one another. What is happening though is that the market does agree about what this stock is worth. You know, for, let's call it 6 weeks, the market agreed that this stock was worth $8 a share, and that's really what's important. When we talk about low volatility, we're talking for situations where the market agrees about what the stock is worth, and that happened there. Now I could draw lines here and say that, oh yes, they're converging. In this point, they're not really converging, but they are going sideways, and so that's also important. Okay, any other questions on what we've covered so far before we move on to risk management? When you said in day trading there is more emphasis on abnormal activity, you mean volume. Well, it's both. Volume is more important, yes. Yeah. But we still want abnormal price action as well. We want stocks that have come alive that investors are excited about. And that's the only stocks I day trade. So I day trade a different list of stocks every day. I go through every stock on the US market because my tool doesn't cover the Canadian market, TradeStation. So I go through every stock in the US. Let's say there's 8,000. I go from 8,000, I look for some specific things, which will show the active trader people on Monday. So I go from 8,000 and I go bring that down to maybe 30. Some days it's 20, some days it's 50, but it's usually around 25, 30 stocks. And then out of those 25 or 30, I look at the chart patterns and I try to whittle that down to maybe my favorite 10 or 15 to monitor for trades. Is there a good trading platform for Canadian stocks that you could recommend? Well, not really. TradeStation is my favorite pattern. It doesn't cover Canadian markets. All of the Canadian brokers will have their platform. I don't think any of them are great, but they're sufficient for what we do. And you can sort of apply that method on those platforms that you get from your broker in Canada. What they don't do, however, is use my indicators because I've written those indicators for TradeStation. So if you are one of my active trader students, you have to subscribe to TradeStation. If you don't want to subscribe to TradeStation, then, or you don't want to do the work, then I have a service where I'll do all that work for you called Active Live. We'll talk about that later as well. You get access with the Active Trader course to all of my TradeStation code, but you still have to, subscribe to TradeStation. And I want to emphasize, I have absolutely no affiliation with TradeStation. They don't pay me. They don't ask me to do this. That's the tool I've used for 15 years, and I like it. And one person one day said, "Oh, you're getting paid by TradeStation." I get nothing from TradeStation. So let me make that perfectly clear. All right, let's move along and do risk management. So, number one goal in trading. Whoops. Number one, sorry, I gotta minimize something here. Number one goal in trading is not picking the right stock, is not knowing when to sell. It's capital preservation. Okay, that is the number one goal. And the reason, of course, is that if we don't have money, if we lose it all, then we're out of the game. We don't want to be gamblers. We don't want to approach the market like a crazy person. We want to approach the market with a disciplined, risk-managed approach. What that means is that we don't think about how much we can make, we think about how much we can lose. And that is the nature of risk management. We use, and in these examples, I'm going to assume we are buying, but everything I say can be used for short selling as well. We just flip it upside down. So When we buy a stock, let's say a stock was in a pattern called an ascending triangle and then one day broke out. And we can see that pattern. We know the reason we are buying it here is because there's abnormal activity that breaks it out. And we know that our last inflection point low was $9 and we're buying at $10. All right, that last inflection point low is the minimum that investors were willing to sell for on the last little move down. So that last inflection point low is not just an arbitrary number, it has meaning. It represents what investors believed the minimum value of that stock was. And then one day a group of investors found some new information that made them willing to pay $10 per share. They have some new information that justifies that. Now what if that information was wrong? Let's say this is a mining stock and there's some information that some investors get that this company has found a new gold mine somewhere. And so they're willing to pay $10 a share because if there is a new gold mine, this stock will be worth $20 a share. Well, what if that rumor was incorrect? What's going to happen to the stock? It's going to fall back and go below that last inflection point low. And so it makes perfect sense then that if we are going to buy the stock at $10, we should plan to lose if it goes down below the last inflection point at $9. So $9 is the support price, entry price is $10, and from that we can define our position size. Okay, if we are buying at $10 and we're going to take a loss if it goes down to $9, that means we have a risk per share of $1. If we buy one share, our risk is $1 plus commissions. Now, if we are willing to lose, let's say we're willing to lose $100 on any trade, then we would buy how many shares? $100 of risk divided by $1 of per share risk is equal to 100 shares. So in this example, if you are willing to lose $100, you buy 100 shares. If you're willing to lose $400, then you buy 400 shares. Now we have to understand that we maybe won't get out at exactly $9. It could fall below that a little bit. So our $400 of risk in this situation could easily turn into, a $450 loss because there's a little bit of slippage and there are commissions. But the basic concept is that we can plan our losses for something close to what our risk tolerance is. Now, risk tolerance, what is that? How much are you willing to lose? If you have a $100,000 portfolio, you might say, well, based on that, I'm willing to lose 1% on any one trade, so I would be willing to risk $1,000. Another person with the same portfolio might say, well, a $1,000 loss makes me feel uncomfortable. I can't sleep well at night knowing that I could lose $1,000 on one trade. I'm going to only risk $200 because that is my sleep well at night number. So that is that person's risk tolerance. Every trader, every investor has a different risk tolerance. It's based on your sensitivity to the money, your age, whether you're close to retirement, how much capital you have in general, personality. There's all kinds of things that contribute to it. But when you start out trading, I want your risk tolerance to be 0. I don't want you to risk anything. When you start out trading, I want you to trade in a simulated fashion, either paper trading where you write down the trades on paper and just watch how they do, make sure that you understand how to do it well, or use my trading simulator at tradescores.com. It's a free tool that you can use. Go there, set up an account, and you can buy and sell in a simulated fashion, and it will calculate for you your risk reward based on a level of risk that you you apply. Okay, now the other thing that we use these risk-reward concept for is risk-reward lines. I can draw a line that is a multiple of my risk, and I can extrapolate those higher. So this line would be at $11 because I was stop, or my support is at 9, I'm entering at 10, the difference is 1, right? Well, another $1 higher is 11, this one would be 12, 13, 14, right? So in terms of risk-reward lines, this is a 1 RR line, this is a 2 RR line, 3, 4. What that means is that this is a reward for risk of 4. At $14, I am making $4 a share for having risked $1 a share. If I bought 400 shares for $400 worth of risk, then up here at $14, I'm making 4 times 400. I'm making $1,600 in profit on that trade. So let's look at a real example where we have less noise on the chart. Let's use this buy point right here. So there is my entry signal price. You could argue you'd use this one as well, but just use this one for now. My last inflection point. Well, where are there 4 candles to the left and 3 candles to the right that are lower? This one we go 1, 2, 3, 4. So this was my last inflection point low right there. Okay, so my support is at 1350. And I'm buying right here at, let's just for simplicity, let's call it 1550. It's probably a little lower. Well, I can then draw lines of equal spacing higher at 1750 because it's $2 a share in risk, right? So at 1750, at 1950, at 2150, those are now reward for risk lines that I can extrapolate higher. I can also draw a risk reward line of -2. Okay, this is -1, this is -2, this is 0, this is +1, +2, +3. Up here, the stock has gained 3 RR from where I bought it. Okay, 1, 2, 3. What that essentially means, if you always take your loss when the stock falls to -1, then a stock that goes up to +3 pays for 3 losers. Right? Every strategy that I teach has a different approach to where you take your loss. Generally speaking, we take our loss at -1.3 RR. In other words, just a little below the last inflection point. And I'll show you some results from the month of May's day trading, and we'll apply different loss limits and show how it affects results. Do that later. Okay, so in this one, let's say we buy this little flag break right here. So the stock is abnormal, it has a good move up, then it pulls back, and then it breaks the flag. It's a good buy signal. So we're going to buy at 750, and we're going to have our stop loss point at $7. That means at $8 I'm making 1, at $8.50 I'm making 2, at $9 I'm making 3, and it never got to $9.50, did it? Okay, so this is 1, 2, 3 RR. This is 0. This is -1. Well, it never went down to my stop loss point, so it never got stopped out. And in fact, it went up, and so it was a profitable trade. This is where we get into exit signals. We are going to use those lines to know when to exit a trade. And we're going to exit when one of those lines is broken. Okay, so let's imagine that's our stock chart. We had an ascending triangle right here. We had a breakout to $10 with support at $9. Let's now draw the risk-reward lines. That would be at 11. This would be 12, 13, 14, 15, and 16. So what we do is if we have a exit strategy, which is trail by 1 RR, what that means is that every time it crosses above a line, you move your support up to the line below. So here it crosses above the 12, which is the 2 line, right? 2 RR line. So now we're going to put our stop loss point at 11, the 1 RR line. And then it moves above 13, so now our stop will be at 12. Moves above 14, so now our stop will be at 13. Moves above 15, so now our stop will be at 14. And in this case, we got stopped out at 14. We exited the trade automatically when it hit that $14 price because we were trailing by 1 line. So people often say, well, can I use a trailing stop? I don't really like trailing stops. A trailing stop is a situation where you say, I'm going to trail the high by $1. So if it goes up to $15.20, then my stop will be at $14.20. If it goes up to $15.30, my stop will be at $14.30. That is not bad, but I find it far more effective to stutter your move of your stop every time you cross above an RR line, because it allows more flexibility in how the stock moves along the way. You know, upward trends don't go straight up. They do this. And so we need to have some flexibility for these little pullbacks so we can stay with the trade until it ultimately reverses trend and we want to get out. Okay, so we exit stocks based on these reward for risk lines, and every strategy has a different set of exit rules. When I'm day trading, the most profitable thing to do is just hold until the close, not even use RR lines. Still use a stop, but not use RR lines. When I'm swing trading, usually I use something called trail by 2 until 5, and then trail by 1. In other words, give it some room early in the trend, but once the trend is cooking along, then have a more aggressive exit strategy, trailing by 1. Now we can also use patterns to exit. So if you have a stock that's in an upward trend, you can just sell when the trend line is broken. So if the trend line gets broken, sell. If the trend line goes parabolic, then get more aggressive than if the trend is linear. These are all things that are discussed in the exit signals lesson, so I won't go into it in a lot of detail, but what I find that works the best is reward for risk lines. And the reason it works the best is because it takes the emotion out of it. It's a very mechanical, methodical approach, and you just don't get as caught up in the emotional attachment to money that we have. And so this is what I encourage everyone to use. If you're a really good chart reader and really good at discipline, then things like break of trend and defining support with inflection points can work better. Most of us aren't capable of that, including me. I do use reward for risk lines. Okay, any question on that before I move on to this concept of expected value? Okay, got a few questions here. Can you please share with us your risk tolerance? No, it's irrelevant. My risk tolerance has nothing to do with yours. I have traded for 27 years and I have a fairly significant amount of capital, so you really have to let your personal situation define your risk tolerance. And I don't want to tell you what mine is because I don't want to taint anyone's view. And it changes. If I'm like, it'll change with strategy, it'll change with the state of the market, that sort of thing. When I'm testing a strategy, so for example, I've just automated one of my day trading strategies where I'm getting the computer to do most of the work, and I'm still testing that, so I'm not throwing a lot of risk at it. But I increased my risk this week from what I was using a week ago, because that's how I work. The way you should do this with risk is, as I said earlier, everyone should start with $0. I don't know why it does that. $0 of risk and get success. Earn 10 RR in my trading simulator or doing it on paper. Once you get 10 RR, maybe increase your risk to $50, $100. Get 10 RR. Once you've got 10 RR, maybe jump it to $200. 10 RR there, jump it to $300. Slowly increase your risk as you get success. And if you then lose 10 RR, maybe you get emotional and you start breaking the rules, then go down a level. Maybe go down 2 levels. Maybe go back to 0 if you find yourself getting emotional. And so, like when I develop a new strategy, I start with 0, I test it a lot, and then I start with a low amount of risk, and then I increase it slowly until I get to either my personal risk tolerance, or sometimes with some day trading strategies, there's a limit to how much you can risk on a trade for liquidity. You can't really risk $5,000 on a day trade because unless you're working the order a little bit, because it's hard to get that filled without a lot of slippage. So there is upper boundaries on what you can risk on some trades. Not so much position trades, but day trades certainly there is an upper boundary. And it depends on the liquidity of the stock. If you're trading a stock that trades, say, 30,000 times a day, my guess is the risk limit is probably $2,500 without moving the market. And you can go more. You can go up to 5,000, let's say, but you have to stage your orders a little bit, work them a little bit, not do them all at once, that kind of thing. Okay, so that was one question. Next question is, when we buy a stock breaking out from low volatility, will it typically have stock scores 60 and less than 80 since the historic pattern was boring? No. The stock scores are designed, and this is position trading, so if you're looking at a daily chart on the Stockscores website, if it's breaking out from a predictive chart pattern, it should be greater than 60, I'm going to just erase some of this stuff here. So it should be greater than 60 on the sentiment. I know my handwriting is terrible. I'm writing on a computer screen that moves a lot when I write, so it's hard to write. And greater than 80 for the signal. Typically. Now the only time that doesn't happen is if you have a stock in a downward trend and then it breaks there. Sometimes this will be more like 50 and this will be more like 70. This can often be above 80 though. So there is a strategy that you'll learn called a bottom fishing strategy, which is kind of this pattern, and we lower the stock scores for that strategy. But most of the time when you are position trading, it's going to be greater than 60 on the sentiment and greater than 80 on the signal. Next question. Do you calculate a certain percentage of slippage when entering and exiting trades? Is there an average percentage that slippage seems to come into account when entering and exiting? So good question. The answer is it depends on how much risk you're taking. If you're taking $100 of risk, you'll get far less slippage than if you are taking $1,000 worth of risk. Because obviously if you're taking $100 of risk, you're going to buy fewer shares than a person buying $1,000 worth of risk would take. And so the result is you can get filled closer to the entry signal price. However, with that said, commissions are a more important factor when you have a low amount of risk. Because if you're buying 100 shares and you're paying $10 of commission, it's a bigger percentage of your overall position size than if you're buying 5,000 shares. Okay. Next question, are you back to using hard stops again? Well, it depends on the strategy. If I'm day trading, I use hard stops. For any other of my longer term strategies like swing trading or position trading, I use the concept of stop on close, which means the candle, if I'm looking at a daily chart, for example, if the daily chart closes below my stop, then I'll exit. I won't exit if it just hits my stop on the daily. When I'm day trading, I pretty much always use hard stops. Having said that, with day trading, it's actually more profitable to use no stop. So the strategy that I'll be teaching the active trader people next week Statistically, if I show you the data over a large number of trades, like over 4 or 5 months of trades, thousands of trading examples, it's more profitable to use no stop and just hold until the close. The problem is there's more volatility in your capital base. So you'll have bigger drawdowns when you use no stops. So I personally don't like big drawdowns, and I think most people don't. So I do use a stop when I day trade. But if you strictly want to apply the statistically most profitable approach, it's to not use a stop. It seems counterintuitive, but and what it means is that occasionally you take a big loss on a stock, but it's offset by the fact that some stocks come right back after they hit their stop. So I'll show you some of those results later today, and we'll demonstrate that. In the month of May, using a stop was more profitable than not using a stop, but May was kind of a very low volatility month, so I think that's why. Does TradeStation put RR lines in? It does if you do what I tell you to do in the video, which is how to set up the RR line tool, which is a variation of the Fibonacci tool. So one of the videos on TradeStation will show you that, but it doesn't do it automatically. You have to do that for it. I have programmed TradeStation to do that. So if you're one of my active trader students, then starting Monday, you will see that I've got some tools built that automatically do that for my active trader webinars. And it's the service that I offer. You know, and this only started a couple of months ago, but in the past, you kind of had to have TradeStation. But TradeStation's a bit expensive, and it's a great program, and I love it, and I encourage people to use it if you're going to day trade. And again, I don't get paid to say that. Don't think that. But at the same time, it requires a fair amount of expertise, and it costs, you know, $350 Canadian a month. If you're in the U.S., you can have an account with them. You don't have to pay that. So what I decided to do is take everything I do and automate it so that you can just watch my webinar, and the cost is less. It's $195 a month, and I'll do all the work for you. You just have to wait for the alerts to sound, and it will actually show you the position sizing and plot the RR lines and all that kind of stuff. So all of my active trader students will see that on Monday. It's a pretty cool setup. And that's just something I built. I hired someone to help me program all these things, spent a fair amount of money on it, and it's now working great. Next question. So you trail by one RR line sometimes. When do you do that? More so with position trades. Not trail by one is usually a position trade, but even like statistically, the trail by 2 until 5, which means you trail by 2 RR lines until you hit the 5th one, and then you trail by 1 RR line. That usually works the best for longer term trades. And that's the reason why is that stock trends tend to start slowly and end quickly. So it takes a little while to build momentum. It's kind of like getting a train started. But once the trend is underway and it's got good momentum, then you can get more aggressive with your exit. Next question. Does working through one brokerage or another tend to be quicker to fill your order? I don't think it matters. Oh, like one over another? Yeah, I suppose. You want to have a broker that gives you direct access. With direct access, you don't go through a market maker. Market makers can slow the process down a little bit. Nowadays, most brokers are pretty fast. You should be able to get your order filled within a second or two. Some brokers are faster, though. They can be less than a second. I don't know that it always helps. But you don't want a broker, like I can remember in the old days having to wait 20, 30 seconds until I got my fill confirmation back. That doesn't really exist anymore, though. So, but if you're looking for a broker, look for a direct access broker, one that sends your order directly to the market rather than going through a market maker, because that can slow it down. These stocks that recover from stops are results of market makers hunting for them? I don't think so. Nowadays, I suppose there's a little bit of that it's not market makers anymore, it's computers. Computers will sometimes let a stock drop to an even dollar value where they know that people will have a lot of stops, but it's a little bit of a conspiracy theory that some people blame for why their stocks get stopped out and then go right back up again. My broker doesn't see my stop loss points, or they don't see my, yeah, they don't see my stops because I execute them manually. They're automated, like I'm very disciplined, but they don't see it. It still happens. So I don't really know that it's a conspiracy thing. So the $195 per month for the active traders, can you email me more information? I'll ask you to email me because I'll forget. But just send me an email and I will make sure you get that. That email goes out to everyone that has ever taken my active trader course. The problem with email is that it's a little bit unreliable. So it could be that it's just landing in your junk mail folder. If you use Gmail, look in your all mail folder and look for emails from me. But I did send out those kind of things. Can you send active alert by text message or to cell phone? No. And the reason is not that technically it's difficult to do. It's that it's too slow. So I have to have that webinar going because that's instant. It's live. You're seeing my screen on that active live webinar. And so when the computer triggers an alert, it announces, there's a little voice. It's not even my voice. It says strategy alert. And leading into a potential alert, in the 2 minutes leading up to it, it will actually put a little word on the screen that you'll see. It says IPB long, and that tells you to get ready with your order. So it's all automated and it's fast and it's instant. But when I send out text alerts, those can be delayed by 30, 40 seconds, even longer sometimes. So that's just not really effective. And remember too that these day trades are things that you're only going to hold for a short amount of time. So these are all stocks that we close out before the end of the day. So you kind of have to be able to sit in front of your screen for that service for the first 2, maybe 3 hours of the day. Most of the entry signals come in the first 2 hours of the day. Can you share who you use as a broker? Well, I don't want to endorse anyone because I haven't done enough work to say this is a great broker. I'm not fond of any broker. I think they all have weaknesses. Currently, I am testing interactive brokers. I find it working pretty good. I find that they're expensive if you buy large share positions, but if you buy smaller number of shares, like under 1,000 shares, they're very cheap. Their platform is complicated but has a lot of great tools in it. Just takes time to learn. They got some good things, but I think you have to be fairly sophisticated computer-wise to use their platform because it's not easy. So, but in the past I've used Disnat. They're going to a web-based platform, which is slower, and so I'm not too fond of that. But there's probably other brokers I haven't tried, so I don't want to say use this one because I use it. I haven't checked out every one of them, so I'm sure there's lots of ones that'll do the job. All right, I think I've got caught up in the questions, so let's move on to expected value. And I'll stop again to answer more questions later. And of course, you can always email me as well. All right, so what is this concept of expected value? So I'm a strategy trader. I don't trade based on gut feel. I don't trade based on what I hear about in the media. I trade because I have identified a set of rules that historically have been profitable. That does not guarantee that they will be profitable tomorrow, but chances are pretty good. And to start with all that, to start with this concept of strategy trading and expected value, or to start with this concept of strategy trading, you need to understand the concept of expected value. What this is a process where you define a set of rules, you test them, and you look at a large sample size to see if those rules made money over time. All right? So I could have a buying strategy that says buy when there's abnormal activity, and this might have 5 rules. And then I'd have my sell rules, and that could just be based on my RR lines. So trail by 2 until 5, one simple rule, trail by 1, an alternative rule. And I have my risk management, which tells me how many shares to buy. So that's my strategy, okay? And you guys are going to learn my strategies. But those strategies, if I didn't do a lot of work, they maybe don't work, right? In order to know whether that strategy is worth trading, I have to test it over a large sample size. Now, a large sample size is not 20 trades. It's hundreds of trades across different market conditions. And through that testing process, I can define the probability of success and the average profit and the average loss. So if I define a strategy that says it makes money 70% of the time, it makes money, and when it makes money, it makes $2, and 30% of the time, it loses $1 per share. Okay, I can then calculate the expected value of that strategy. I can say I have a 70% chance of making a profit, and when I make a profit, on average, I make $2 per share. And I have a 30% chance of losing money, and when I lose $1 a share. And so 70 times 2 is 140, and 30 times 1 is 30, so that gives me an expected value of $110. That means if I did this 100 times, I would expect to make $110 using a risk tolerance of $1 a share. Okay, so here's an example. I want everyone to read that and just make sure you understand this calculation right here. Trader has a strategy that makes a profit of a reward for risk of 2 on average. It might make a 6 sometimes, it might make a 1 sometimes. On average, it makes a 2, 65% of the time. And 35 times out of 100, it loses a reward for risk of 1. And therefore, you can calculate the expected value as 95. Since that expected value is positive, it is a profitable strategy. The assumption here is that what happened in the past will continue to happen in the future. No guarantee of that. You know how you always hear people say historical results do not guarantee future success? That's kind of what they're talking about. They're saying, well, the past is a representation of the future. Unless you do good strategy testing, the past is not necessarily an indication of the future. And that's one of the problems I have with these guys that promote their historical results, is that they're grabbing a moment in time when that strategy worked, and their sample size is too small, and their sample size is focused on a certain market condition. For a strategy to be effective, you have to have a large sample size, so lots of trades in your sample size. So you want that to be big. And you want your sampling to be done across market conditions, so different markets. So how did it work when the market was trending up? How did it work when the market was trending down? How did it work when the market was going sideways? And from all those things, if you do good testing with no biases in your testing, which is a very difficult thing to do, then you can develop a strategy that has a positive expected value, and hopefully it will work in the future. So this is what I do. I develop strategies. It's my favorite thing to do. Let's go into the spreadsheet that I have here. So this is a tracking of all of the trades that my strategy identified in the month of May. Okay, I have a computer help me do this. So every day I list all of the stocks that were on my day trading watch list. Now, incidentally, everything that I'm showing you here is things that I do in my live trading webinar. So when you guys start on Monday, for those of you who are new, when you start on Monday, you're going to be given a watch list by me. We're going to put the watch list. It's on a webinar. I can't lie about it, right? This is all stuff that people have watched me do. So I don't want you to think that this is something I just sort of kept to myself and there's no proof. Everything that you see in this spreadsheet was based on the Active Trader Live webinars that were done for the month of May, and actually went into June a couple days. Okay, so for example, on June 1st, there's the date. These were all the stocks that were on my watch list. There's actually a few more. Oops. Okay, trying to show you all of the stocks from June 1st, but it's a little hard for me to grab it exactly here. Okay, so there's all the stocks from June 1st. You can see there's quite a few of them. There are, let's see here, 964, so there was 33 stocks on the watch list on June 1st. Some of them were longs, that's an L. Some of them were short candidates. I also rate the stocks on my watch list. So part of that service that I offer you is I will put a score on the stocks. 2s are the best, 1s are okay, 0s not great. I personally only trade the 2s. All right. Now then I calculate some statistics. I calculate abnormal volume, I calculate abnormal price, I calculate the max drawdown and the max gain of those trades. I calculate the reward for risk earned using different exit strategies. So here's the trail by one exit strategy. Here's holding until close but moving a stop up to the break even if you hit 2 RR. If you hit 3 RR, moving the stop up to break even. And here's simply holding until the end of the day with no close, or with no stop rather. And that is the RR earned. So this trade right here, PDCO, stock I actually traded, if you held until the close, earned an RR of 4.94. If you go onto Twitter and look me up on Twitter, I'm always trying to get people to follow me on Twitter, so I'm going to manipulate you into following me on Twitter with this. Go onto Twitter, look up @Stockscores. You will see I did a tweet on June 1st, maybe June 2nd. I'm pretty sure it was June 1st, where I show my actual trades from June 1st, and you will see that I bought PDCO, and you'll see the dollar profit. You'll be able to calculate what my risk was on that particular trade from that. You'll also see that I bought Dollar General, and you'll see most of these stocks on here because the 2s are the ones I bought. I think I missed one of them. I think I missed PF, unfortunately. Otherwise, I mean, I'm not perfect. I try to do every trade, but I missed some of them. Anyway, you will see that I did those trades, and there's always some slippage, but you'll get a sense of the profitability of those, okay? So who cares, right? Now let's look at how these results work over time. So from this, I can accumulate what the net gain over time is. So here is the 2-rated trade. So this column right here is the profitability over time for the month using $1,000 of risk. I use $1,000 just because it's a round number. We can figure out what the RR is. So only looking at the 2-rated stocks with a stop at minus 1.3 for the month as of June 1st on trade number 933, and I didn't do 933 trades because I don't take every trade, only took the number 2 ones, okay? So anywhere you see a 0, there was no trade taken for this column. So there was a whole bunch of trades that were never taken on this particular strategy. Anyway, as of June 1st, it was a profitability of $84,986. That basically means an RR of 85. Okay. The day before, early in June 1st, it was 69. So it was a good day on June 1st. So the profitability grew from an RR of 70 to an RR of 85. And ultimately, by the end of the day, it was an RR of 86.9. How do I know it's 86.9? Because you can see there in the spreadsheet, it says 86,926. Divide that by 1,000, that's 86.9. I can then chart those gains for the month in what's called an equity curve. So I've got different lines that you're going to see on the equity curve in a moment. They represent different exit strategies. So if I took all of the 2s and I had different stops of minus 1.3 or a stop at minus 1.8 or a stop at minus 1.3, that's what these columns are for. And you can see that the wider stop of minus 1.3, earned an RR of 74.3, but that tighter stop of minus 1.3 earned a stop of 84.9. Now this doesn't factor in slippage. It assumes you take every trade, which we don't. I always miss a few. That doesn't always hurt me. Sometimes I miss some of the bad ones too. But generally I try to take every trade. There's slippage in here. You're never going to earn what this is. I always try to discount this by at least 10% for slippage and commissions. But anyway, let's look at the equity curve now. So the blue line, which you see up here, is using only the 2-rated stocks and using a stop of minus 1.3, otherwise just holding until the close.
The orange line is only trading the 2 rated stocks and using a wider stop, minus 1.8. And the gray line is only trading the 2 rated stocks and having a stop at minus 3, holding until close. Now this green line, which is far below, is trading the 1s and the 2s and having a wider stop. So this one is less fussy. And look at the difference in RR. This one earned about 35 RR, and this one earned about 90 RR for the month. Big difference. And all that changed is my rating system. So when you're on the Active Live webinar next week, if you're an Active Trader student, you will see my ratings. I do that for you in the first hour. So I'll make the watch list, I'll rate them, and then we trade them. Now, some of you may say, but Tyler, I'm not day trading. I don't want to day trade. You can do the same concept for swing trading, for position trading. Because I primarily day trade, I've got lots of data for day trading. And so I wanted to show this, and I use day trading because that's where I get my data from. Now, when you are building strategies, what you want is that equity curves that go up from left to right steadily over time. And you can see that this one pretty steadily has risen. This is just the month of May. If I showed you this going back 3 or 4 months, it would be even more steady. Okay, May was kind of we had a couple weeks here, right here, the last week and a half up until Thursday and Friday, when the market had very low volatility, and you can see that the equity curve actually dropped. That's called drawdown. That's normal in strategies. So we had, good first week and then some sideways action and then a good little rally in the sort of the second week and then some sideways action and drifting lower for about a week and a half. And then the week finished, or the month finished well. The last couple of days of the sample size were good. And that's normal. That for my strategies anyway, that's normal. If you ever look at some of the high-frequency trader guys, I've seen a couple of documentaries about these guys. They have equity curves that just go like, that are much less volatile. They just do this. But they're using incredibly sophisticated communication systems, very expensive communication where they're using high-frequency trading, where they're doing trades in microseconds, millions of dollars of investment to get an equity curve that is that smooth. So I'm pretty happy with my equity curve. It's, steadily going up from left to right. There is some chop, if we talk about volatility, there's some volatility there. But there's less volatility if you have a tighter stop. If you look at this line, and you can look at this on the video later, the blue line is less volatile than the green line, or less volatile than the gray line, because the gray line has a wider stop. So you'll see more deviations from the mean with the gray line or the green line because they have a wider stop. Okay, so that's a little bit on expected value and that sort of thing. So let's talk quickly about stop. Actually, maybe I'll see if there's any questions. Pause for a moment and check my questions that have come in here. How are you guys finding this so far? It's good? Okay. Do I give that spreadsheet template to active trading students to use? I give a simple version of it. And so at the end of the month, if you're an active trader subscriber, and most of you that are on the active program will be for next month because you get that with the course. Anyway, if you do that, at the end of the month I'll send you my spreadsheet, but it doesn't have all of the stuff in there. There's some proprietary things in the one I just showed you that I want to keep, but you will get the data and you'll get a lot of the things that I collect, and you can do a little bit of work with that as well. So I try to send out at the end of every month. Are your ratings for stocks you might trade each day subjective? They used to be. Now I've pretty much got it totally objective. It's computer driven. And this is a cool thing that even the people that were in my active trader webinar last month won't have seen yet, because starting Monday I've got it computerized. So we just finished that, and I was testing it yesterday. It seemed to work good. I might have to tweak it a bit through the month because it is new, but it's the scores will actually dynamically update through the day based on the computer model. So I've spent tons of time and money building these things. What you see on the Active Trader webinar starting tomorrow
or Monday, is probably 2 years of work. So, and a lot of money because I can't program this stuff myself. I have to hire people to do it. Okay, do you buy or sell at market? Depends on the strategy. Day trading, I pretty much always do market orders because I'm trading very liquid stocks. If I am position trading, not necessarily market orders because those are less liquid. All right, let's get on to the stop losses section of the presentation today here. So a stop loss is an automated order. Well, typically it's an automated order that you put with your broker. So you buy the stock at $10 and you put in a stop at 9. If the price was at 10 and it falls down to 9, it automatically gets exited. You have two choices. You can have a market or a limit order. A market order says if it hits $9, it will sell at whatever price is available. So if there's a buyer only at $8.50, then your market order gets filled at $8.50. So you don't want to do market orders with stocks that are not very liquid. By liquid, I mean how actively they trade. If the stock is traded really actively, then chances are if it hits at 9, you'll get filled at, $8.97, something like that, because it's actively traded. So the more liquid a stock is, the more likely I will be to use a market order. Okay. If you trade a stock that trades 10,000 times a day, market orders are fine. When you start getting down to stocks that trade 1,000 times a day, 2,000 times a day, market orders can be less good. You can have a lot of slippage, and so then you want to maybe use a limit order. The problem with a limit order is, let's say we have that stock, we bought it at 10. So we bought it at 10, it went up for a bit, we had a stop at 9, and then it fell, and it hit 9. And you have a limit order that says if it hits 9, sell it at a limit of $9. Well, if there's no buyers at $9, because it goes down super fast, there's no buyers at $9, you won't get filled. It could go down to $8. You're still not filled. It will only get filled if it were to come back up to $9 and then hit your limit price to sell at 9. So the problem with a limit order is you're not guaranteed to get out if the stop is triggered. So I generally, first thing is I generally want to trade liquid stocks, actively traded stocks, so I can use market orders. And that's with day trading. I almost always use a market order with day trading. If you are position trading or swing trading, you have more time. The trades are not as time sensitive. The stops are a lot wider. And so there I think using limit orders is okay, because usually what we do is something called stop on close. Now, the most common question I get is, Tyler, my broker doesn't offer stop on close limit or stop losses. That's because no broker does. This is a concept, not a type of order. A stop on close order is something that you manually do. If your stock, you bought it at 10 and it closes at 8.90 one day, and in your evening work you take a few minutes each evening to check your stocks and you find that your stock closed at 8.90, then the next day you're going to manually sell it at whatever the prevailing price is that morning. So stop on close is you want to see the candle, the relevant candle to what you're trading, close below your stop loss point. So if you're doing a weekly strategy, let's say you're doing the Stockscores Simple Weekly, which is my longer term investing strategy, then what you'd be looking for is your weekly chart to close below your $9 stop. So on Friday, did my stock close below $9? Yes, then I'm going to sell it Monday morning. That's what stop on close is. Okay, so the benefits of a market order gets filled quickly. The weakness, you can get some slippage. The benefit of a limit order is you get less slippage, but the weakness is you may not get filled at all. Stop on close is a concept that we use for position trading mostly, a little bit on swing trading, and it's looking for the relevant candle to close below your stop loss point, and then you manually have to exit it. It requires discipline. You have to do the work, right? You have to do the work, first of all, to see if the stop was triggered. You also have to do the work to exit and be disciplined in that. Scaling. So each one of these concepts that I'm going through fairly quickly is all covered in the Stockscores Education Center. So I just want to show you this in case some of you aren't aware of it because you haven't had a chance to look at this yet. If you go into the education area and go into Foundation, there's videos on all of the things that I've talked about. In some cases I'm going through these
concepts in 5 minutes, but there is a 35-minute video that explains the expected value of the trade. I don't know if it's 35 minutes. So now we just did stops. Now we're going to look at scaling. Scaling is basically adding to a winner. So anytime you get a new entry signal that is at a higher price than your previous entry signal, then you buy more. So let's say we have a situation like this. Okay, so we have a break from an ascending triangle, we buy. Okay, and then it goes up some more, and it goes sideways again, and then we get another entry signal up here. We can buy more of the same stock as long as the new support price is higher than the previous entry. So the new support here is greater than this. Therefore, if you get stopped out here, this position is going to be profitable. This position will be a loser. And so you might end up breaking even. But if the stock continues higher, now you've got twice the position to enjoy the gain. It's basically adding to a winning horse. You know, if you were to go to the horse races and you're betting on horse races, if you could bet on the horse that was leading going into the final straight, you know, and add more money to your bet, you could increase your winnings because you've got a better probability of winning, right? So when you have stocks that have good upward momentum, you want to add to them. And we do that by scaling in. Now there's a difference between scaling and building a position. So let me draw another little diagram here for that. So if we have our ascending triangle, we have a breakout, buying at 10, stop at 9. Let's say we know for a fact that stocks that break out often pull back after they break out. I would say 65% of the time that happens, probably more, probably 80% of the time. And so you could say, well, I'm only going to buy half my position on the breakout, and I'm going to look to buy the other half on the pullback. And you might get to buy the other half at $9.30 as it's starting to turn higher again. So that's building a position. You buy a portion of it initially and you buy more later, building your position. You still have your same stop loss point, and you only add, you know, only buy the second half of your position after the pullback and waiting for it to go higher. Now I just said that roughly, I'm guessing, 80% pull back. So you might say, well, why wouldn't you wait for every stock to pull back and pay a lower price? Good idea, except the stocks that don't pull back, you know, the 20% that don't pull back are often the biggest winners. They're so strong that they never even get a little pullback. They just go rocketing higher. And so if you wait for the pullback, you miss out on those big winners. So that's why at a minimum, I would say buy partial position on the breakout and then buy some more of it on the pullback. That way you don't get left behind if the stock doesn't pull back, but if it does, you can lower your average cost on your entry. Okay, so in this example, if we bought breakout here and then it made another breakout there, well, this new inflection point low here on this buy is higher than my original entry, so I can add to my position. Now my new stop is here. If this position gets stopped out, this one will be a slight winner, right? And this one will be a loser. We don't take on as much risk, but we have more upside potential if the trade continues to work. Same thing with the day trade. You could buy some on this flag break here, buy some more there, because my new stop is higher than my previous entry, and therefore it is a scale in. Time frame confirmation. All of my strategies have a core time frame that the entry signal comes on, but also all of my strategies have a second time frame that you look for a confirming signal. So for example, when I'm day trading, jump into TradeStation here, I'll show you this. When I'm day trading, just gotta move something on my screen here. Okay, when I'm day trading, let me think of a stock that I day traded on Friday. Oh, it was so long ago, it was a whole day. What did I day trade on Friday? CCIH. Okay, so when I day trade, I always look for my watch list stocks to be based on this little pink dot here, which is called an action candle indicator. So the reason I had CCIH on my watch list on
Friday is because the 13-minute chart told me that investors were excited. It was actually the second day in a row because I also had a pink dot on Thursday. So that's what put it on my watch list. That's the longer term time frame. Now my actual entry signal came on the 2-minute chart. So if I go to the 2-minute chart here, my entry signal came, I got to remember, probably right, pretty sure it was here. No, actually it wasn't. It was here. I was losing for a while on it. So, and this is all computerized. So when you're on the Active Trader webinar, these alerts get spit out by a computer. I programmed the computer to tell me when the alerts come. Anyway, it was somewhere in here. I can't remember. What was my point in all that? Oh yeah, so the entry signal is based on the 2-minute, but my confirming signal is on the 13-minute. And I actually do also look at the daily chart for the more confirmation. So in the process, and again, some of you don't know the rules yet, we'll teach you them next week. But all of that has time frame confirmation on multiple time frames. Now, let's say you are a position trader and you're going to hold stocks for weeks or months or years investing, right? So then I go to my market scan tool. Let's say I run my Stockscores simple weekly scan. And I've got, too many. I don't like that many. I'm going to do the Canadian market. It won't be so many to look at. So let's do Stockscores Simple Weekly Canada. There are 51 stocks to look at. When I look at these, the weekly strategy is based on the weekly time frame. So I can click on 3 year at the top of the chart here, and there is my weekly chart. I say, hey, that looks pretty good. That's a nice ascending triangle break. It actually broke last week, but it got more follow through this week. So that's a nice ascending triangle breakout on the weekly chart. But let me also look at the daily chart and see how the pattern looked. Okay, probably it started to move on Thursday, so I'm maybe 1 day late on this one. If I'd done my market scan each evening, I would have picked up this stock on Thursday when the volume first jumped, but that's okay. Okay, so I always look for time frame confirmation. If I see a good daily chart, let's see if I can find another one here. If I see a good daily chart, that one's pretty good, but not great. Then I'll take a look at the weekly time frame for confirmation. So we'll be practicing this next week. So SunOpta was a good daily chart back right here where I'm circling. Hopefully you can see that. Let me actually have a tool where I can draw this. So on this day right here, that was a good breakout. There is a resistance line. I've got some compression of volatility here. I've got rising bottoms. I have optimism. I've got abnormal price action. And if I go down, let's see where the volume for that day was. Must be this day here. Wouldn't be the red day. I don't know why that's like that. Anyway, it has what I like, right? Abnormal volume, abnormal price action, breaking through resistance. It's a little choppy, more choppy than I like. Okay, so that was the day that it started to move. Now, if I look at that on a 3-year weekly chart, I can see a problem. The problem is that it's going to find resistance at an old inflection point, because there is pretty strong resistance right here. Everyone see that? Now my downward trend line also, actually the downward trend line was broken, so that was okay. So the main issue with this, when I look at the longer term time frame, is it's going to run into a lot of resistance at $14 a share. So if I was buying on that initial break at 11 and my stop is at 8.50, I have $2.50 a share in risk. As a general rule, I want double the upside for the downside. That's a 2. Okay, so if I'm taking $2.50 a share in risk, that means I need $5 of upside. Well, to go from, say, $11 to $14, that's only $3 of upside. And that is why I didn't personally take that trade, because I think that it's going to get stuck at 14 and it's just not enough upside for my risk. Okay, so that's all part of the application of the strategies. All of those things are taught when you go into the education area.
going beyond the foundation, some of those concepts are there, but when you go actually into the strategies and review the Stockscores Simple Weekly Strategy, there are things discussing the reward or risk lines and how you use the stop and how you look at the charts. It's all taught in that lesson. There's a video as well. So again, today we're kind of giving you the broad overview so you get a sense of where everything fits together, why we do all these little things. I'm giving you the quick version, but I do encourage you to still go back and review all this stuff. All right, trading styles. What are the right trading styles for you? We have position, swing, and day trading. Position, holding stocks for 2 weeks to 2 years. Swing, holding for 2 days to 2 weeks. And day trading 1 day. You're out of your positions before the close. What is the right one for you? Well, depends how much time you have. Day trading is at least 3 hours a day. At least 2 hours a day, but ideally 3 hours a day. If you can do it all day, even better. Swing trading is about anywhere from 30 minutes to 60 minutes a day. Don't have to do it every day. Position trading is anywhere from, say, 10 minutes a day to 10 minutes a week, depending on the strategy. So time difference is significant. You can spend 10 minutes a week doing position trading, or you can spend 6.5 hours a day day trading. Interest. What is your interest? I love trading the market. I would do it if I didn't make money at it. That's just fun for me. So when I go on vacation, drives my wife crazy. I look at the charts every day. Done that for 27 years, and I'll probably do it for another 27. Because I'm interested in it, but not everyone is. Some people want to just manage their retirement portfolio and, golf or hike or whatever you like to do in your free time. So don't be a day trader. But if you like the market, if you like sitting in front of a screen, then that's a great thing. And the beauty of it is you can do it anywhere. In the last 2 years, I lived in Maui for 6 months. I lived in Whistler for 6 months. I live in Kelowna, which is one of the nicer places in Canada to live. It's on a lake, although the lake is getting a little flooded these days. Lifestyle is something that you can pick if you day trade, because you can live anywhere that you can plug a computer into the wall and get an internet connection. The only time I've not been able to day trade is when I'm on a cruise ship, because usually once a year when my family takes a cruise, and the internet connection is not reliable enough for trading. So that's one way for my wife to stop me from trading, is to go on a cruise ship, because she knows I can't do it. Personality, I'm not very patient. I like fast moving. I walk fast. I talk fast. I don't have patience. So for me, day trading is good because I get instant gratification. At the end of the day, I can see how much money I made. With position trading, sometimes a position trade won't be profitable for 2 months after you buy it. And you have to be patient for that trade to develop. And for some people, that's good. They don't like the fact that day trading is volatile and exciting, fast moving. They want slow and methodical and less stressful, I guess. Right? Position trading is less stressful than day trading. I would say it's less exciting, but some people would say less stressful. So which one you pick is up to you. I just wanted to give you some things to think about. So reverse engineering the stock market. Using the past to predict the future. All of my strategies start with an idea, and it always starts with a stock that I wish I would have bought. Okay, so I might look at CCIH and I would say, I wish I would have bought it here and be up, at that time it was $1.15, that was a Thursday, and it closed Friday at $1.70. So it's gained almost 50% in 1 day from the entry signal. That is a stock I wish I would have bought. So then I say to myself, well, what are some of the signals that I should have bought it then? Well, I can see that there was abnormal price action and abnormal volume. That's why there's a little pink dot there. I can see that there was boring, sideways, low volatility trading before that pink dot. I can see on my daily chart that it was breaking the downward trend line. So now I can say, okay, I am going to trade when I see an action candle, which was that pink dot,
action candle from low volatility, breaking resistance. I know my handwriting is terrible. I wish the screen didn't move so much. Break resistance on the daily. So there's 3 rules. I've reverse engineered the stock market. I started with a stock that I wish I would have bought, and I've looked for some things in that stock that stand out, and I've devised 3 rules, and I can now test those rules over a large sample size to come up with a strategy. So this is essentially the Stockscores simple swing strategy. We look for action candles. You can do it with TradeStation. You can actually do it with Stockscores as well. Not as cleanly on Stockscores, but if you go into the Stockscores simple swing strategy, there's the concept explained and the rules. And it's basically doing what I just showed you on the 13-minute chart, looking for action candles, breaking out from a predictive chart pattern and looking on multiple time frames. And if you go into the Stockscores market scan tool, there is a strategy called Stockscores Simple Swing right there, which you run about an hour after the market opens and look for stocks on the 13-minute chart that are breaking from a predictive pattern. So we have to look at I'm not looking at the right chart here, but so on the 10-minute chart for this stock, or the 30-minute chart, sorry, the open on Friday, it broke with strong volume from some sideways trading. Not quite ideal, not good enough for me, but that's how you would do it with Stockscores, right? So that's reverse engineering the stock market, and that is how I come up with strategies. So you develop a strategy by starting with an idea, working backwards to come up with a set of rules for entry, exit, risk management, define the process for finding them, which is as important as the rules. If you don't have a good process, you don't find them in time. That's why I develop tools for TradeStation or for Stockscores on the market scan tool. Without those tools, you can't find them in a timely way. So you have to have process. You have to keep your strategy simple. I've seen people with strategies that have 500 rules. They don't work. Keep your strategy simple. They should have just a few rules. Those rules should be concise and they should be understandable by anyone. If your rules are buy a good chart pattern, that's too subjective. If you say buy a breakout through resistance if the last inflection point low is higher than the previous inflection point low and the volatility has compressed where the line drawn across the tops and across the bottoms are converging toward one another, that is more concise, right? That's something you can program into a computer. And this is the most important part, testing. You have to test your strategy over a large sample size across different market conditions to find what the expected value is. So I showed you this spreadsheet. What happened to my spreadsheet? Oh, there it is. I showed you this. This is the sample or the testing from my intraday pullback strategy for the month of May. I have this for April, March, different months. I've been kind of improving how I develop or compile all this data, but this data is extremely valuable to me because it is where I can gain new rules. It's insight. Data gives you the insight to make decisions. You should not make any decision anywhere in life without data. That's my feeling. So, if you feel like every time you eat bread, you get a headache, well, maybe you're intolerant to gluten. I don't know. So do a test, collect data. Eat bread one day and then don't eat it for a week, and then eat it another day and then don't eat it for a week. And if on the days after you eat bread you don't feel well, maybe there's a problem. You're collecting data, right? And there are lots of people doing this. There's a podcast that I listen to every week by a fellow named Tim Ferriss, who wrote the book called The 4-Hour Workweek, among other books. Great podcast. And so many of his guests are about collecting data and making decisions. And that's really what he does. He experiments. He says, okay, if I do deadlifts, will I get stronger? And he does the deadlifts and he finds that he gets stronger. So he's done an experiment to build lower back and core strength and hamstring strength, and it allows him to jump higher, right? It's just data. So that's how I approach kind of everything I do. Emotional control. Are you normal? If you are a normal human being, you are predisposed to fail in the stock market. So if you are emotional,
then you will lose money. If you keep your emotions in check, then you can make money. Do you guys like my drawings? Very talented. So human beings are predisposed to fail in the stock market because they have fear and greed. And fear and greed are what make you make emotional decisions. So we have to get rid of those things. And so I've got a module in the foundation area to help you with that, but let me give you the basic concepts. First concept is don't take more risk than you can tolerate. So if you don't sleep well on the risk that you're taking too much risk. And you're likely to become emotional. Second thing, have a plan. You should have a written plan for when to buy, when to sell, how to manage risk, the process, how to track your results. If you don't have a written plan, then you will become emotional. So do these two things, and you've got a chance at becoming unemotional. I say a chance because it's very difficult to keep your emotions out of trading. And that is the most difficult aspect of trading. You know, understanding the rules, I can teach you the rules. You can write them on the back of a napkin. A lot of work went into those rules, but understanding them is not that hard. Following the rules, now that's hard. And I can't teach you that. I can teach you the importance of that. I can give you some tricks to do, risk tolerance, plan, but only you can keep your emotion out of it. And it's not just risk tolerance and plan, but eating properly, meditating, getting exercise, getting enough sleep. All of these things can help you keep your emotions in check. If you do cocaine and sleep 3 hours and eat pizza at every meal, you're probably going to be more emotional than me because I don't do any of those things. All right. Now there's some further information in that module in the foundation area on emotional control that you can study and learn from, but this is the challenge. So one of your tasks when you take my course is to make your trading plan and email that to me. And in your plan, I want it to be 1 page per strategy, concise and designed such that a computer could follow it. Don't make it too vague or subjective. There's other elements of emotional control, trying to be perfect. That doesn't work in trading. Having pride, check your ego at the door. Anger, being mad at the market, blaming the market for your losses, doesn't help you. The market doesn't care about you, doesn't care if you make money, doesn't care if you lose money. Don't get angry at it. Only get angry at yourself, and even then you're wasting your time because it's only going to make it worse. Impatience, when the market's quiet, you force trades, trying to do too much in a market that doesn't work. Lack of focus is the opposite, though. I wrote my weekend video that just went live this morning on YouTube is kind of about impatience or about a lack of focus. And you have to do your work every day if you're a position trader using the daily strategy, or every week if you're doing the weekly strategy. And if you say, well, the market's lousy, so I'm not going to do the work this week, that might be the week that the market takes off and you missed it. So anyway, all of these things, these emotional control elements, are written about in a book called The 7 Deadly Sins of Trading, or something like that. It's out of print, so it's really hard to find. I've kind of summarized it in the lesson, but the author's name is Ruth Behrens Rothschild, or what's her last name? 7 Sins of Trading. I'm probably screwing that up. Should be enough to Google search Ruth Behrens. She's got like a hyphenated last name. Some of you may know the book. Maybe you're telling me about it in the questions here. Let me just see here. Roosevelt, thank you. Ruth Behrens Roosevelt. Probably spelling this wrong too. Anyway, great book. Very hard to find because it's out of print. So what I did in this lesson is I kind of gave you the high points of that. Okay, we're almost done. Then we'll take some more questions and we'll be able to finish up maybe a little bit earlier than 3 hours. So create a trading plan. Your rules for entry, rules for exit, risk management, process, chart example. Okay, so there's a lesson that describes this. What I like to see is 1 page per strategy. So if you're doing the intraday pullbacks, it should be 1 page. Very concise. A lot of times I see strategies that are too vague, they're too subjective. Be very specific in the rules, concise, specific. And beyond the 1 page, you should also have an example of a chart that meets your criteria. So that can be a 2nd page, so that you know visually what you're looking for, so that when you're applying that strategy, you have something to go to say, that's what I'm looking for. Okay, that's your trading plan. So tools. Use the Stockscores website. There's lots of videos on the foundation area on how to use Stockscores. TradeStation, there's videos on that as well. I'm going to come out with a new video for TradeStation soon because I've updated a few things. I have some new indicators, some new processes. So I'm going to do an update video that will be put in the Stockscores Education Center because I've done so much work in the last, well, really 2 years to improve things. So got some new stuff coming along. What you see on there now is fine. It's just I got some new indicators that'll make your life easier. And then the Active Live is another service that I offer. I'll just show you how that looks. I think I have it here. So for those of you that are active students, on Monday, you will see this screen on the webinar, some charts. And what I do is I post the watch list here. So I'll have a list of all the stocks on the watch list. It looks bigger because it's a different screen. It won't be so hard to read. And when there is an entry signal, you will hear an alert sound. When a trade is triggered, you will see it highlighted over here. You'll see the profitability for the day. It's got all kinds of information. And you just watch the webinar and I'll explain it for the first hour or so, Monday to Thursday. We'll actually do a recording. I'll explain how I build the watch list and how I monitor the trades. But then after Thursday for the rest of the month, I'll do it. I mean, I'll talk a little bit, but I don't talk too much. But you'll see my watch list. I'll rate it. You'll see a rating on the stock. And when there's an alert, when the computer identifies an entry signal, it will sound. If I want, I can click on the symbol and it will actually show the entry point. So you can see here, there was the entry signal on Microsoft. And there was the reward for risk lines. This is all generated by the computer. I used to do this manually, but it's a very repetitive task. So with some help of some great programmers, I was able to program it all, and that's what you'll see on Monday. Okay, that's Active Live. That's a new product. I've been doing it for a few months, but it's in the way I do it, it's gotten, I think, more sophisticated in the last little while. So for the investor students, we will be doing market scans each evening. So starting on Monday, you will log into the webinar and you will see this screen, and we're just going to do market scans together. The first night we'll do them slower, maybe not do as many market scans. So we'll do Abnormal Breaks Canada, we'll run the scan, we'll select all, and we'll view the charts together, and I'll explain why I like something, why I don't like something. And then as the lessons progress, we'll do them a little more quicker and try to do more of them. So those are Monday next week, not Tuesday, Wednesday, Thursday, and then the following Monday. They start at 6 p.m. Pacific. If you're in the Active Trader course, you can do these as well. And they'll go about an hour. They will all be recorded. Active Trader starts on Monday. So Education Week is next week. So Monday, Tuesday, Wednesday, Thursday, for about the opening hour, I will teach you how to build your watch list and how to monitor for trades. Okay, those will be recorded. The rest of the day will just be the computer alerting you to stocks that are on the watch list, triggering a trade or a signal. Doesn't mean you take the trade. You still want to look at it, do your own checking of it. The computer's not perfect. It's pretty good though. All of the trades that get triggered, you can check the score. So when the trade is triggered, it'll have a score. So if Microsoft triggers a trade, like if you look at Microsoft on this screen here, see there's the 2 there? So it's a 2-rated stock. If I pull up another stock, it might not be 2. So IBM is a 1. See, it's all automated now. I used to have to enter these in, but starting Monday, that's all automated. So Microsoft is a 2, so when it triggered an alert, and you heard the word strategy alert, that's what you'll hear, not my voice, you can check the score. It's a 2, okay, take the trade. The trade was triggered right there, and by the end of the day, it had earned a 2 reward for risk return. Okay, so it's pretty cool. I'm pretty excited about it. I don't know if you guys think it's cool, but I'm a nerd. So Monday, Tuesday, Wednesday, Thursday is education week, and then for the rest of the month, I'll build the watch list. I talk a little bit. I don't talk a lot. I can answer questions if you have them. And then generally, I'm sort of there for the first hour and a half or so. Each day, we will review the trades from the previous day. I will show you the spreadsheet that I built. Okay, the spreadsheet, I bring it up every day. We look at what the RR was for the day. We look at you know, what stop worked the best, just some little bit of things that I notice to help you guys. And then we do the trades. And none of those are recorded though, because I can't record a full day, and it's super boring to have a 6-hour video. Anyway, so we will only record the first week, Monday, Tuesday, Thursday. Okay? That's it. Questions? Is it too late to join the Active Trader course this time? No. I'll just send me an email and I'll look into it. Yeah, I got to see if I missed any questions here. There's been quite a few comments typed going off my screen. Okay, so for stop on close and position trading, do you have an opinion on using a market seller order entered during the night versus waiting until open the next day and entering it manually? So I would prefer waiting until the next day and entering it manually. It's safer. Sometimes, you know, if a stock gives an exit signal, it could gap down in the open and then come back a little bit. So it's a tough question to answer. Generally, for myself, I would execute the order manually the next day, but I'm also there every day doing that. If you're in a situation where you can't be at the market open, then just exiting on the open at a market price is okay. The good thing about the open is there's lots of liquidity at the open, so it's usually better. Now, with that said, it's important to know that you cannot do market stops on the Toronto Stock Exchange. You can do market orders, but you can't do market stops. Just wanted to get that in there. Did you say you should have 2.5 RR in a trade to make it worthwhile? No, I said you should have at least 2 RR potential to make it worthwhile. Not 2.5, 2. And I have lots of trades that don't make 2 RR. But you want that much potential up to the next level of resistance. Okay, next question. Is it good to use the stops on the price relativity tab on Stockscores for swing and position trading? No. No. That's no, don't use that. Use the inflection point method that I've taught you. Do I ever sell a position because you found one you like better? Yeah, if let's say your capital is all used up, you've got everything invested, and you've got a stock that's doing nothing, just trading sideways, and not making you any money, maybe take that money and put it into something that's moving better. So someone's done a overview of that book, The Deadly Sins of Trading. I don't know if I think I can actually answer this and everyone will get the link. Let me just see if this will work. Hold on a second here. So I've just answered a question and sent everyone the answer. So you should see the question as well, which has the link to someone's overview of that book I talked about. Is the automated score in TradeStation for the stock part of the TradeStation indicators? No, that's only for the Active Trader webinar. Does the watch list change after it is set in the first 2 hours or so? It could. I generally don't add any more stocks to the watch list. You could. It's kind of like one of those things where you can do all that work and not add anything all day. And generally the stocks that you add later in the day won't be a 2-rated one. So can it happen? Yes.
Every week there's one or two that I miss because I don't build my watch list all day long. But it's kind of like it's a lot of work for not a lot of result. But if you're there, you may as well do the work if you want to keep yourself busy. What RR number do you use to determine to take the trade? RR numbers have nothing to do with whether I take a trade. RR numbers are how you measure the success of a trade. The only thing you do is you want at least a potential RR up to the next level of resistance of at least 2 for most of the strategies. That's not always the case, but for most of the strategies. I see sharp spikes for a second sometimes, and it will pick up your stop. Yeah, that can happen. That's why you want to trade liquid stocks. So when I day trade, I only day trade stocks that have at least 10,000 trades a day, and I actually prefer those that trade 20,000 times a day. So when I'm rating those stocks in the watch list, I'm using, to get a 2, I'm currently using at least on pace to trade 20,000 times a day. One of the reasons I do that is there's less chance of those little quick spikes that rip out your stop because they're just too liquid to have someone manipulate the market like that. Next question, is there a minimum market cap of stocks I enter? No, there's not. It's liquidity driven. And if not, is there a risk of your students affecting your strategy? Yes, and that's why I do liquidity. So I don't care about market cap, I care about liquidity. If I'm day trading stocks that trade 20,000 times a day, and everyone in my active trader webinar all buy the same stock at the same time, because those stocks are so liquid, they can absorb that. If I said, here's a trade alert on ABC Mining that trades 100 times a day, I mean, we can make that stock move up 20% in 5 minutes because a group is all buying it at once, right? So I'm really only focused on liquid stocks. Now, if you want to trade less liquid stocks, then you can do all this work yourself and apply the same set of rules, and you will be able to find those stocks that I'm not focused on because I only focus on the liquid ones because I have the problem of the fact that there's lots of people watching what I do. So don't feel like you have to focus on the highly liquid ones. I'm handcuffed, I guess, by the fact that I've got a group of people that follow me. Now, one of the things about what I do is I don't let that many people take my active trader webinars because you have to have taken my course first. And, that's a barrier to entry. To pay the cost of the active trader course is something that keeps a lot of people out. That's great. That's why I want it. I don't, some of these guys on the internet teach a course to people every weekend in a different city, or, they teach massive numbers of people. I don't want to do that. I don't want that many people to know my strategies. I teach a small number of people. I enjoy it. I do it twice a year. I don't want to do more than that. I could probably make millions of dollars teaching this to people all over the world, but then it would stop working, and I'd rather make the money trading. Another question. I am an active student but unable to attend the webinar during the day next week. Yeah, if you're on the list of my active trader students, if you register for the webinar, you still have to click on that registration link. You will get the video of the webinar Monday to Thursday. There is no video beyond that, so if you can't watch all month, then you're going to miss some of it, but you will get the recorded parts. How many trades for U.S. and Canadian stocks is the minimum you would use to enter the trade? It depends on the strategy. So in the strategies, there are explanations of how many trades you want in order to be able to consider those. For example, if you're doing the Stockscores simple weekly on a Canadian stock, like to me the minimum there is 100 trades per day. Same with the Stockscores simple. So generally for Canadian position trades, 100 is good. Swing trades, 500. Day trades, 2,000 for the Canadian market. For the U.S. market, I increase those because the U.S. market trades differently. So in the U.S. market, I might say for a position trade, 500 trades a day. Swing trade, 2,000 trades a day, and day trade, 10,000 trades a day. For every market scan every morning, what all indices you have applied to? For TradeStation, I follow the New York and NASDAQ. I don't do the other markets. I think I follow the Amex, but there's very few stocks that come up on the Amex for us. Do Canadians have restrictions on foreign stocks that we can buy? I don't
think so. Maybe outside of North America. I think it's really hard to buy stocks in China, for example, but I only trade the U.S. market, and there's no restrictions there that I know of. I've never been told I couldn't. The only thing that happens is if a stock is dual listed, let's say you have a stock like Bank of Montreal that trades on the U.S. market on New York as well as on the Toronto Stock Exchange, in theory, you're supposed to buy it on the Canadian market. Some brokers don't apply that rule very well, so, and I don't even know if that's still a rule. It used to be. I assume it still is. I don't know for sure. All right, any other questions? What do you guys think of this? Was it too much, or was it good? I mean, remember, this is the overview. You really should be spending 6 to 8 hours of going through all the material to get it. And some material you're going to go through more than once. But I wanted to give you a sense of how everything works together so that you can now start to attack the pieces that you didn't quite understand or need more work on and that sort of thing. So I'm going to wrap it up now, and I will be emailing a video link out to you so you can watch this again if you have no life today, but it probably won't come out today. It takes a long time to compile these videos, so it'll probably come out tomorrow or Monday. Otherwise, I will see the active trader people Monday morning. Make sure you register for the webinar that was linked to in that email I sent you, because that gives you the link to sign in. And for the investor people, we'll see you Monday night at 6 p.m. Pacific. And if you can't make it for one of those, they will be recorded, so I can send that out to you as well. Have a great rest of the weekend, and we'll see you guys next week. Thanks.